PharmD Nation, do you own your own company stock inside your qualified retirement plan like a 401k? If you do, you need to be aware of the Net Unrealized Appreciation rules. I'll explain. So in general, whenever you pull money out of a retirement account like a 401k, everything that's distributed out of that account gets taxed to you as ordinary income. The counterpart to ordinary income for a lot of people is capital gains tax, which is the way you get taxed on any gain, but at a lower rate than ordinary income. I know that's a simplified way to put it, but let's just think of those two like that. Well, if you own a company stock inside your 401k, part of that stock is probably going to get taxed as ordinary income when you pull it out. The other part could get taxed as long-term capital gains if you follow the net unrealized appreciation rules. For example, let's say that either you yourself through a 401k or your company granted you its own company stock. And let's just say you either bought or the company granted you that stock, and the average price of that was $10,000. And now that stock has grown to $50,000. Well, when it comes time to distributing that money out of your 401k, if you take that money, that stock out of your 401k, $10,000, which is your cost basis, will get taxed as ordinary income. The other $40,000, if you follow the rules, could get taxed as long-term capital gains, which is usually a lower tax rate for a lot of people than what ordinary income is. However, if you take that money out of your 401k or those stocks out of your 401k and roll them over into something like an IRA, you will lose that NUA ability to treat that gain of that employer's stock as long-term capital gains. So it gets really confusing, and there are a lot of other additional rules tacked onto that, and this is just a simplified version of what it's all about. But I just wanted to make sure you knew, PharmD Nation, that if you own employer securities inside your qualified retirement plans and you think you anticipate you are going to either roll that money out or spend it, just be aware of net unrealized appreciation rules, because they could come into play and provide a great benefit to you from a tax planning standpoint if you ever encounter something like this in the future.